Well, let's get back to our top story today, a shrinking Canadian economy. The GDP story showing a contraction in the second quarter, and that wasn't expected. On Bay Street, overall, there was an expectation we'd see growth. Even the Bank of Canada's own forecast was for growth, which means that interest rate hikes are having an impact. We talked earlier about household spending, which has been slowing. And with a Bank of Canada interest rate decision around the corner, there are many suggesting we might be near the end of the rate hike cycle. Let's get some more insight and analysis from Andrew Kelvin. He's head of Canadian and global rate strategy at TD Securities. Andrew, great to see you. What was your reaction to this GDP report?
I think the takeaway is that rate hikes are starting to work, and that the Bank of Canada can sort of revert back to that wait-and-see approach that they had a little bit earlier this year. As you noted, the interest rate-sensitive sectors of the economy really showed a lot of the weakness, were responsible for a lot of the negative surprise in that Q2 GDP number. I wouldn't get too hung up on the idea that the economy contracted. Part of that was an inventory adjustment. But the fact is, household spending is slowing. Residential investment is slowing, so the housing market is starting to show some impact of the high rates. I think this supports the governor's assertion from back in July that interest rates are starting to have an impact on the economy. And I think it lets them be a bit more comfortable than perhaps they otherwise would heading into next week's rate announcement, leaving the overnight rate unchanged at 5%.
Yeah, that's your expectation.
That's our expectation.
Don't make a change. Now, obviously, this is, and everybody's watching central banks everywhere with this tricky dance of cooling an economy. That is part of the goal here, to fight inflation. But the recession worries are constant. Even if you look at the data points and add it all up, you could make a case for us being in a technical recession. So how would you characterize the shape that the economy is in and where we might be as we roll into next year?
I think you look at the big picture and you look at the evolution of the economy over the last 2, 3, 4 years. The economy is in a pretty good place in terms of the sort of level of employment in the economy. The unemployment rate's still relatively low in sort of the mid to low fives. That does speak to a reasonably healthy economy, but it's one that is slowing. When we talk about recessions are about the rate of change, not the level of overall activity. Just simply having had one negative quarter, and the fact that we do think Q3 will be pretty weak as well, it does open up the sort of conversation around a potential technical recession. But at the end of the day, we just think the population growth in the economy is too strong to really see a hard landing for growth in Canada in aggregate. Even if at the individual level, households are really starting to feel the pinch and people feel as though they're in a recession, we think that the population growth will ultimately keep the economy from falling into a recession on aggregate.
And what does that mean then for interest rates over the long term? Because arguably a year ago, well, we were probably talking about interest rates a year ago, but let's say a year and a half ago, it was inflation this and inflation that. And we're still talking about inflation, but just about everybody's talking about interest rates now. I had a conversation yesterday with the former Bank of Canada Governor, David Dodge, who looks at the economic realities of how the world is reshaping post-COVID and said people should not be expecting rates to go back down to the levels that we saw before the pandemic hit. So is there, if the economy softens and rates stay at these elevated levels, something that people have to get used to, the idea that we might see a cool down and we might see interest rates stay at these levels even if the bank is done hiking?
Certainly. I think that period that followed the financial crisis, right with the pandemic, that was historically a very abnormal period. The overnight rate never reached above 2% in Canada for a decade. If we move back to those levels of the overnight rate, it means something's gone terribly wrong for the Canadian economy, and that is not our expectation. For the Bank of Canada to talk credibly about cutting rates, we need to be in an environment where inflation's sustainably at or on its way to the 2% target. Inflation's above 3% today. Core inflation metrics are above 3.5% today. Even if growth is starting to slow, the Bank of Canada can step back and wait for this slow growth to translate into slower wage growth, into slower inflation. But ultimately, that's the next step that will take several quarters to be realized. And I would agree with the former governor, seeing an overnight rate of 1 or 1.5% in the next few years seems very unlikely.
So just to wrap up really quickly, a more normalized economy could be on the horizon.
Yep.
But maybe households should just get used to the idea you might have a little bit less to spend than you had when rates were at zero?
For households with significant leverage, yes. I think that period of very low interest rates was something that we shouldn't expect to return. I don't think we want to see that return, frankly, because I think that was highly distortive in many aspects of the economy, particularly the housing market. It's not going to be something that highly levered households like to hear. But at the end of the day, we were always talking about a neutral rate for the overnight rate being sort of somewhere in the 2 to 3% area. That's the sort of target I have in mind further down the road, not the 0%, 1% we were seeing prior to the pandemic.